Hi, I'm Jim Elder, a director in our investment management segment at S&P Capital IQ. We are here today to discuss the key findings of a new publication called Fixed Income IQ, which is specifically designed for fixed income professionals in the investment community. Fixed Income IQ is a quarterly publication produced by S&P Capital IQ that leverages comprehensive proprietary analytics and data to provide you with quarterly trends in the global fixed income markets. In this edition, we are focusing on corporate credit in North America, Europe, Asia Pacific, and Latin America. I'm here today with one of the authors, Jay Bankaria, a senior manager in the investment management segment, who will step us through some key observations from this exclusive and complementary publication. First, we will focus on North America. In the first quarter, we have seen prices rise across all sectors, with investment grade and high yield bonds returning 2.6% and 3.1% respectively. The chart you see here shows the all-in yields across the 10 GICS sectors at the BBB level during the first quarter of 2014. Jay, maybe you could step us through some of the trends that emerge from this chart.
Sure. Thanks, Jim. So across the board, we're seeing yields tighten over the past quarter in line with the price increases you mentioned. Looking at the 10-year BBBs on a sector basis, we see the most tightening for utilities, with yields dropping from 4.8 to 4.2%. The smallest drop in yields for the first quarter was consumer staples, only decreasing its yield from 4.4 to 4.3%. Both are non-cyclicals and have the lowest yields of the 10 GICS sectors. We noticed that in March, all yields start to rise, attributable to Fed policy statements, as noted by the circle in the graph. On the next chart, we're looking at the Z-spread term structures for all corporates bucketed by rating category on a year-over-year basis. The solid lines represent the current credit spread of each group of corporate bonds, while the dashed lines represent their spreads from 1 year ago. Once again, we see significant improvement in credit quality throughout most ratings categories. On a percentage basis, investment grade curves have tightened more than their high yield counterparts. The only rating group to widen has been CCC, which is represented by the two lines at the top of the chart. The shape of these curves may not look intuitive at first, but once you strip away the interest rate risk from the risk-free rate, it's inverted due to the high risk of default in the couple of years present for issuers within this cohort. It's also noticeable to mention that most of the issuers that make up this CCC curve are consumer discretionary as well.
Great. Thanks for that perspective on the bond markets. Moving to Europe, we have seen big rises in issuance over the past quarter. Jay, could you walk us through what's happening here?
Yep. Here we're looking at all bonds issued in euros and British pounds during the first quarter of 2014 versus the first quarter of 2013. We see significant gains in all ratings categories. As credit stabilizes and rates improve, investment-grade issuers are taking advantage of low interest rates. We've seen AAA and AA issuance increase by 120% and 69% respectively. The biggest issuers in this section include Anheuser-Busch InBev, Spanish telecom group Telefonica, and the leasing arm of VW.
Thanks, Jay. I'm definitely interested to see if this continues. We're just looking at corporate debt here, but with even Greece planning to issue nearly 2 billion euros in debt this summer, the appetite for European debt is definitely rising. Next, we'll turn to APAC for a look at how the CDS market is viewing credit risk. We'll do this through the lens of the CDS market-derived signal, or the CDS-MDS as we like to call it. It is derived from CDS spreads, calibrated to Standard & Poor's ratings, and really looks to capture the sentiment of the markets. This next slide shows the difference, on average, between these two metrics across the 10 GICS sectors. A bar above 0 represents positive sentiment from the CDS markets, and below 0 is negative sentiment. And the scale is the number of notches between the metrics. For example, the CDS markets view information technology in the most recent quarter 1 notch, on average, above the S&P rating for companies in that sector. Jay, what are the biggest takeaways on this chart?
Sure. So on this chart, we can see that the CDS market is scoring the materials sector in aggregate about 1.3 notches greater than the ratings. The average S&P rating for materials in APAC is a BBB-, while the CDS market is pricing them at a BBB+. One company with the largest divergence between the ratings and the CDS market-derived signal is Reynolds Group Holding, which they have a S&P rating of B versus a CDS market-derived score of BB+. You'll also notice a sharp rise in the CDS market's perception of the energy sector over this past quarter, which is now about 1 notch higher than its rating level. So this would be an interesting sector to keep an eye on moving forward.
Thanks, Jay. Now we'll switch gears to Latin America, and we'll look at probability defaults coming from our market signals model, which interprets signals from the equity market to take a view on credit risk. To demonstrate how this works, we see in the next chart that the PD is generated by this model for every company globally which suffered a ratings default or selective default. We can see that over the past 10 years, PDs start to rise even 1 year before default, nearly doubling to 20%. And I'll note that the starting value of 12% is several times higher than the average PD globally, so they are already viewed as risky firms even 1 year before default. Now, we'll look at average 1 year forward-looking PD levels for the 10 GIC sectors within Latin America. Jay, can you step us through some key observations here?
Yep, so on this chart, the sector with the biggest credit improvement has been consumer staples, which has decreased its PD by 54% to 0.6%. The sector with the largest PD deterioration was materials, going from 0.4% to 1.3%. Despite these changes, both sectors are in the lower half of all sectors for credit risk. In other words, they're less risky, while utilities has the highest credit risk, on average a PD of about 3.6%. So the PD on aggregate for all of LATAM during the first quarter has actually decreased from 2.3% to 2.1%. Now, LATAM remains very sensitive to the global and regional financial markets. We've seen a steady rebound in LATAM equities in March, but high volatility always remains a concern, especially as financial conditions actually still remain tight in this region.
Thanks, Jay. And thank you for watching. For a detailed look into all regional trends, please read Fixed Income IQ. We hope you found this insightful, and please join us next time.